Thank you so much for joining today. Appreciate folks joining us on this August day, noon here on the East Coast. But I know these are the times when things are slowing down a little bit. So it's really great to be able to convene some of our community here. And we're really excited to have this conversation today. We've had lots of conversations on employee ownership, and this is going to be a really, really special one. Really excited to dig into our new briefing with all of you. Just quick housekeeping. Yeah, there's folks putting their intros in the chat for those of you who are just joining. Would love to see who you are, what organization you're coming in with your hat on today, and then what really brings you to this webinar. Why are you interested? Are you a potential investor in employee ownerships? Are you researching? Are you a fellow ownership nerd like we are? Would love to just kind of like get a sense of who's in the room. This is a real meeting format instead of the webinar, which we've been doing before. So we actually are just going to be using the chat, straight up chat for questions, conversation. So feel free to post either for all to see, or you can just direct message me, Julie, and Nair, who's going to be presenting. And then we can kind of fold that into our Q&A section and conversation as we go. And for anyone who needs closed captions, it's in the three-dot menu. You should see the option there. All right, yeah, let's get started. I know most of the names I'm seeing are good friends and familiar faces, but there are some new folks. So for those of you who aren't familiar with Transform Finance, hello, my name is Kurt. I'm the Executive Director of Transform Finance. And we're an organization that creates insights, connections, and actionable strategies for all stakeholders who seek to challenge legacy investment approaches and to seed transformative investment models. And what do we mean by transformative investment models? Well, we actually developed 3 principles at our founding over a decade ago to really describe, what we think capital can and should look like if it is really to create a better and more equitable society. And that's that those affected have the chance to design outcomes, govern processes, and share in the ownership of investment. Investors add more value than what they extract in returns, and that risks and returns are fairly allocated across all stakeholders. And employee ownership definitely covers these 3 pieces, as we'll get to today. This is a really big area of work for us right now. We're really kind of interested in this ownership economy and shifting wealth and control in many different ways. So this aspect of that around employee ownership is kind of part of our broader work around alternative ownership enterprises. I know many of you have followed our work there, looking at beyond just employee ownership, but other enterprise models that are shifting governance and power. Check out the bit.ly that's on the screen to learn more, and check out our other materials on that. And with that, I'm going to pass it off to my colleague Julie, who's going to take us into the meat of the conversation here.
Thanks, Kurt. Thanks everyone for joining. Really, really glad to be here. Glad to see all of you here, and glad to see a lot of the intros there are super inspiring. I think a lot of you could just be giving this presentation, so definitely keep peppering in any additional thoughts, reactions you have along the way. Really, part of our time today, as you see in the agenda here, is I'm going to share a little bit of kind of highlights from the report. And not everyone reads reports, so this is a good excuse to just get the key insights here in this presentation. Then we'll hear from Aner Ben-Ami, who's the founding partner at Candide Group, about kind of how they approach investing in employee ownership. I think to just keep make it even more practical and grounded, and then really we'll go from there into a conversation. So we'll go into a conversation and break into small groups to really kind of deepen our connections and be able to support each other's work. So let's dive in. As you might have seen, we released this report, and it's really builds, as Kurt said, on our work over the past years focused on raising awareness for and mobilizing capital to employee ownership and other forms of alternative ownership that better distribute wealth and power in companies. So this recent briefing includes kind of a recap of the opportunity, why we think it's an interesting investment area, an overview of how employee ownership deals are typically structured, landscape analysis of the funds, and then guidance for investors at each stage, from getting started to deepening their commitment. You can download the briefing. It's on our website. There's a bit.ly link here. And I'll just share some highlights now. So first of all, kind of why this is an interesting investment area. As you've hopefully heard, employee ownership companies have a range of positive impacts, and I won't go into all the details here, but just at a highest level, employee-owned companies tend to perform better, they're better for workers, and they can reduce gender and racial inequality, wealth inequality. And then they even, some of them can be structured to have beneficial effects on their community and on the broader world. So there's a lot of good things there. Hopefully everyone is familiar with that. In addition, there's a convergence of trends that make it a really great time to invest in this area now. First, we're experiencing this major phenomenon that some are calling the silver tsunami, where over 10 trillion in assets, including 2.9 million businesses, are changing hands. And so as folks of the baby boom generation are retiring, it's possible for them to convert their businesses to employee ownership rather than just selling it kind of in the ways they might otherwise. And the benefits there is that it creates new, long-lasting stakeholder ownership and avoids the harms to workers and communities of a sale to kind of the someone who's only interested in returns. And then second, we're seeing an increase in interest in employee ownership. So there's been a lot of press coverage, for example, of the Ownership Works initiative that is backed by private equity group KKR, where they allocate a small portion of shares in the company to workers. And then when that company is sold again, workers kind of get a share of that sale price, which can be meaningful. And though obviously those models are far from perfect, the press coverage really has raised the profile of employee ownership overall. Third, really a huge surge of experimentations, both in terms of new fund models, so that can include employee-owned conglomerates. It can include these models that allocate corporate equity to a broad base of workers. And then there's also new models, new legal developments around the development of employee ownership trusts, for example. And then finally, bipartisan support for employee ownership is really supporting this movement, as employee ownership, for example, with the support for the Employee Equity Investment Act that would provide financial support for EO conversions funds. And then there's a range of legislation at the state level also. So there's a lot of exciting things happening. So this is why, hopefully, you're all here, and why you might want to invest in this area or learn more about the investment opportunities. So just some grounding in terms of how financing happens, like where you're putting investment capital, where even does it go? Financing happens kind of at three potential stages. One, conversions, which we'll discuss more. Startups, which is investing in a newly created company that is employee owned. And then ongoing financing is also a need, providing kind of working capital, lines of credit, other types of capital for mature companies. So it can, mature employee-owned companies, so it can grow, or for other needs. Currently, most companies become employee-owned when the current owner sells the business to its employees. And so that's what we call conversions, and that's really the bulk of financing activity for employee ownership. And there's a broad range of capital, actually, types of capital that can be used. You see here on this stacked bar. But senior debt here at the top and seller's note are the two by far that dominate by far. And in the context of worker cooperatives, worker buy-in is also, of course, very, very important. And so that's part of what creates sometimes the confusion around employee ownership. So there's all of these different kind of types of capital that one can provide, and that companies can deploy for conversions and for financing. So just a little bit more on conversions, since they're so dominant. There's three main financing pathways for conversion, and this diagram comes from the Creating Shared Value report by Noah Klein-Markman. The first is the majority of conversions to employee ownership are through an acquisition by an existing employee-owned company. And so that company will use its own cash reserves or raise actual dedicated funds. So we know Oberon, Evergreen Cooperatives, others have funds that they're raising specifically for the purchase of of companies that then get rolled up into the existing employee owned company. And this doesn't create new employee-owned companies, but it does increase the number of employee owners or worker owners. So that's one important pathway. Second important pathway is about a third of conversions are these standalone finance conversions. So that's where a company will take on debt from the departing owner and from other capital providers to become to kind of buy out the existing owner. And as I mentioned, senior debt and seller's note are typical here, but there's a range actually of new specialized funds that are providing additional types of capital or deploying new strategies to really grow this portion here. And then the third, kind of a small portion of overall conversions deals are made using the free cash flow of the company and doesn't require external financing. So these are kind of non-leveraged incremental conversions. And one thing to point out here is while these kind of that gray bar here of standalone finance conversions, it's only just about a third. That's where there's a huge potential for growth. Because this combination of like senior debt plus seller financing has really limited the number of conversions that can happen, because either some owners are not willing to provide seller financing, they just want to be fully bought out when they're selling the company. Some businesses don't have the assets needed to meet the collateral requirements of senior lenders, so they just can't actually borrow to make that conversion happen. Or or kind of sometimes all those things stacked together, employee-owned businesses typically can't provide personal guarantees because there's no individual owner that could provide this guarantee. And in some cases with SBA lending, that can be required to provide financing. So those reasons make it tricky, or have historically made it tricky to get these conversions to happen. And that's why we're really excited about this field growing of new specialized employee-owned funds that are working to address this need by providing new types of capital, subordinated, mezzanine, debt, or structured equity, and then the funds that are providing using new strategies. So there's kind of private equity style buyouts that then exit to an ESOP. There's funds that kind of do things that are employee-like features, but not necessarily full models. There's a lot of different ways that this area is growing, and we expect over time that these kind of new approaches will expand the depths and the breadth of employee ownership. Kind of may start to include a broader range of businesses and have historically been able to convert. So maybe smaller or bigger businesses, different industries, and things like that. So that's kind of the quick overview of how financing work and where money is deployed. So I want to kind of dive more now into the details of the funds that exist that can be invested in. And before I do that, I want a few kind of important caveats. First, the source of the numbers that you're going to see now are all from our database of funds that is on our website. And that database is based on desk research and kind of information that we've gotten from the investment teams themselves. So it's essentially a self-reported data, which may contain errors, omissions. So this is all, meant to be kind of directional data, not necessarily all, we know that there are errors and omissions in there. That said, it is the most comprehensive data set out there. So we do think it provides kind of useful information. Second important caveat is this is not, none of this is investment advice. This is really information to help everyone be better informed investors and ecosystem builders. So, do your own diligence. So, with all that said, really the focus of this briefing is on funds, because though it's possible to invest directly in a company that is converting to employee ownership, that's much harder, and funds can be a really easier entry point and reduce risk and kind of provide helpful diversification. And what we have found, these numbers are as of June of this year. There's 53 funds that finance employee ownership in the U.S. and Canada. In total, these funds have raised or are planning to raise $3.8 billion, which is a big number, but also in the scale of assets invested in the world, quite small. And though the field is small, it's also super dynamic, as I've mentioned. Growing. 50% of the funds operating today are less than 10 years old, and over 25% were established since 2020. And then 70% of them are raising capital. So either on an evergreen basis, they have funds that are kind of rotating, provide kind of interest-like payments, and can be, it's not a closed-end funds, and then a number of them are closed-end funds. Vast majority are first-time funds. There's one fund, Mosaic Capital, that is raising a second fund, and only one fund, at least in the data we had, that had confirmed that they were fully deployed, the Boston Impact Initiative Fund 1. So yeah, there's a lot of opportunities out there, a lot of different funds. And just to double click on that, we've categorized the funds by their investment approach, because employee ownership is a quite broad tent, but that when looking to make specific investment decisions, it can be confusing to identify the funds that best align with investors' constraints and preferences. So that's why there's these 8 categories there. I know on the chart, it probably looks quite small, and I'm not going to go into all the details because that would just take too long. But just to give you a sense at the highest level in terms of the funds that we've looked at and are, kind of in this general area, there's a number of funds that are exclusive to employee ownership, and that's the funds that are in kind of the reddish colors there at the bottom of the stacked bar. You can see on the left the number of funds, and on the right the aggregated total that they're have raised or are looking to raise. Then there are folks who are non-EO exclusive. These are essentially funds that have a broader investment strategy. That may be local economic development, it may be climate, it may be supporting underrepresented entrepreneurs, and that they will finance employee ownership in addition to other kinds of business financing. And then there's in the green at the top, those are funds that happen to do employee ownership from time to time, usually ESOPs, as part of a kind of not an impact strategy, just an investment strategy more broadly. I'd love for folks, if we could bring that to life a little bit. I know a lot of folks are on the, on this call are actual fund managers. Others are familiar with them. If you just maybe share a few, if you could share one fund you're familiar with and whether they're, only do employee ownership or if they do other things as well. We'd love to hear just a little bit what folks are familiar with, rather than me telling you all the details there. There you go, Apis and Heritage. Anyone else want to jump in? Oh, but now that Kurt shared the database of funds, cheating. No, looking at the fund. What are the things that folks are familiar with?
Sorry.
No worries. Kidding. Yeah, Evergreen, Oberon, Empowered Ventures. Yeah, keep it coming. Yeah. Common Trust and their fund, the Groundwork Fund. And in terms of the EO exclusive funds, that's 22 funds. I know that's what some folks are really focused on, and that's about 1.6 billion. So out of the 3.8 that I was sharing, so a little bit less than half, and then 31 are this broader category. So that's kind of a can be a really good fit for folks who are thinking about a broader investment strategy, but want to make sure it includes employee ownership. Yeah, thanks for adding Seed Commons, Southeast Acquisition, Mosaic, Boston, Ujima. Yeah, a lot of yeah, keep it going. I think it's nice to have those examples, and then I'll just keep sharing a few more things. So kind of characteristics to consider in funds, I think that's obviously always very important. We've included here returns, size of fund, geographic scope. Clearly, there are many more considerations when you're conducting diligence, but our goal is to help investors find the subset of funds that most align with their priorities and then kind of go from there. In terms of returns, there's quite a wide range, and I think speaking to that, broad tent of employee ownership. For funds that just do employee ownership only, the ESOP conversion funds and the funds that do broad-based employee equity, that's basically when they allocate a portion of the company's equity to employees in a broad-based way, but don't necessarily use a cooperative or ESOP or EOT model. Those are the funds that in general, on average, seek to be competitive with private equity or sometimes private debt returns. While the worker co-op funds generally have internal rate of returns that are more in the single digits. And then the folks that do other impact strategies, so as I said, economic development, underrepresented entrepreneurs, a variety of other impact areas. Those it's in some ways it's a bigger breadth, but the average is lower, at least in the data set that we had. One thing to say here is, a majority of this is where the data is really much more partial in terms of our data set, because that's often not public information. So that's just to give you really directional information. And you can look at the briefing for kind of more details there. There's very pretty charts. And part of why I wanted to touch on this just a little bit is that what we've heard is it can be really challenging to determine the asset class that a fund belongs to, right? Is this your private equity portfolio? Is this your fixed income portfolio? Kind of allocation, and therefore it can be hard to figure out what's the return benchmark you should expect from a fund. And in some cases, as I said, the funds are more like private equity or private credit vehicles, but others are more like cash investments, more like a note. It's a note that you put into a CDFI. That then will be invested in cooperatives, and it's really a known issue here. I'm not here to give you here's how you solve it, but it is challenging to figure out how to benchmark and where in a portfolio kind of an EO fund might fit. So just to kind of invite awareness of that, and then kind of willingness to handle that complexity a little bit. Other two quick things to mention, fund size. Funds in this space are generally small. About half of them are under 15 million in size. Overwhelming number of them are first-time funds, and that's kind of a typical size for a first-time fund. So it's more a reflection of the maturity of the space. And finally, about half the funds operate kind of throughout the entire United States. 11 have a more regional focus, 5 on a single city. And there's a range, but in general, ESOP funds and kind of the partial broad-based employee equity ones are usually US-wide or even North America, while funds that focus on a specific city or a regional fund are more prevalent in kind of worker cooperative or other impact strategies. So someone had mentioned Boston Ujima, it's a great example of it's focused on Boston. It looks at the Boston area and includes worker cooperatives as part of a broader strategy. So that's kind of some tidbits on funds, and there's a lot of charts in the briefing that I hope you will enjoy as much as I do. I love charts. But moving on, wanted to also highlight impact and kind of some key dimensions to consider as you're looking at funds and kind of their impact strategy. First is, I think the one that most folks are familiar with is economic rights. That's what brings many investors to employee ownership, is that it can be a really powerful strategy to reduce income inequality. And so you want to make sure that there is indeed income, and wealth being built for workers. So looking at the percent of economic rights that are going to workers, and then making sure that those benefits are additive, right? That it's not replacing wages or other measures of job quality. So that's the first. The second is one that is not universally happens in all the funds, is really governance rights, and looking at models that can grant essentially this governing power to employees, employee representation on the board, ability to provide input to and accountability, and hold management accountable. And really that's because those things are key to fostering an ownership culture, which in turn drives improved performance, and really is key to providing, higher job quality, and stronger corporate performance. Third, really considering mission protection can be really important dimension of impact. That's something that worker cooperatives and EOTs are better structured for, because it can help prevent the sale of a company. EOTs can even have a structure to protect a company's purpose. And for all kind of considering like, okay, I'm investing in this model, is employee ownership going to be preserved over time or not, can be a really important way to tell, like, to help maximize your impact. Fourth is kind of who benefits, right? We're talking about building wealth for workers, but who those workers are will really kind of shift the impact. So funds that prioritize benefits for people of color, for women, for lower wage workers, or for other marginalized people can have a bigger impact than just a generic worker or employee. We know worker cooperatives, for example, are structured to be more welcoming to people who have been excluded from the workforce, such as returning citizens, for example, and that can be a really important, powerful layer of impact. And then finally, kind of integration with broader movements. Considering if and how the funds are connected to broader networks that are focused on shifting our economic system, can further deepen their impact. So really kind of looking at these as things that can be added on, and kind of the more dimensions you can add, the more deeply transformative your investment can be. Last thing to share is really, there's obviously which fund do I invest in, which ones are a good fit for my portfolio. But there's also how you invest, and when you invest can also be a really important dimension of impact. So as I mentioned, employee ownership is still relatively young and at this really interesting upswing in interest and potential. And so investing early, signaling kind of your investment and sharing it widely, supporting first-time fund managers, underrepresented fund managers, can be a really powerful way to help not just invest in a fund that does good things. It also helps build a field, and then considering where possible and where you have the ability, catalytic capital can really be a way to help grow the field, and support kind of the broader employee ownership movement. So that can be supporting CDFIs and other senior lenders so that they can expand their capacity. As I mentioned up front, senior debt is a really important part of the equation. So as much as possible, helping to build that up. And then supporting funds directly through grants or lower cost capital, so they can provide technical assistance to companies, before or after conversions, covering initial fund operating costs, right? That initial, when you're getting started before you've been able to close a first close, can really help fund managers get off the ground, or kind of providing first loss reserve, or a number of ways to make the fund more robust. So there's obviously a long list of possibilities, but just to give you a sense of thinking about not just like, oh, I did this, I chose the fund or the funds and I'm done. It's like more broadly, how do we grow the field? So thank you all for your attention and all the chatter, which I'm not able to follow in real time, but I know Kurt is, and jumping in where needed. But I wanted to shift gears a little bit. We're gonna now hear from Aner Ben-Ami, who's a founding partner at Candide Group, really a pioneer in this space in terms of multi-stakeholder governance, ownership models that ensure more equitable and fair outcomes for workers and communities. Board members at many wonderful organizations, including Transform Finance, and overall a really deep expert in employee ownership. And there, can you, I see you're
Hi,
here, but can we hear
hi,
you?
Julie.
Hello, hello, how are you?
Doing well, and thank you. Thanks for having me. And as you mentioned, this is such a great group to be a part of. There's so many folks here on the call with deep experience who could be sharing their own knowledge and experience here. So a lot of great fellow travelers, and appreciate being in the conversation.
Yeah, yeah, definitely. It's yeah, a lot of folks here could teach the class.
Yeah.
But we're talking to you today, and maybe to kick us off, I'd love to hear a little bit about your experience with employee ownership. I know you were part of getting organically grown, set up, and Firebrand, and a number of these deals. But more broadly, if you could share with folks a little bit more about your Candide's experience in this space.
Yeah, I mean employee ownership has been a key core area of interest and focus for reasons that I think you highlighted and we'll continue to discuss here today. Really from day one for us, and starting out in back in 2012, we actually provided support to the working world at the time for their acquisition of New Era Windows, or the conversion of New Era Windows in Chicago into a worker co-op. Then continued to support Working World and Seed Commons as that strategy evolved over the years, and also worked with another CDFI with Shared Capital in the co-op space. Um, and then, I think just kind of starting to open the aperture, right, beyond co-ops, right, part of what you're discussing here. And so really between, let's say kind of it was between 2019 and 21, we did a few direct investments. We led a few direct investments. You mentioned organically grown company. That was the first instance of a purpose trust, a perpetual purpose trust in the US, I believe, and worked with our friends at Purpose to co-lead that. And then similar kind of variations on that theme with Firebrand Artisans and Barrett Kohler Group, really looking at more of kind of a multi-stakeholder model, right, where it's workers own to some extent own part of the company in kind of various ways, but then other stakeholders have maybe equal footing, right? Whether it's investors, whether it's suppliers, customers, kind of looking at that model. And then really since over the past 3 years or so, since 2021, we've just, as you're sort of highlighting here, there's been a surge of new intermediaries, right, created to help grow this field, and not just grow this field, but really, innovating, right, and finding different approaches and different ways to go about this, and expand the pie, right, and address or offer solutions for different types of businesses, different types of sellers, right? And so over the past 3 years, we have worked with our clients, right? We're an investment advisory, right? We're an RIA, so we are kind of facilitating investments on behalf of our clients. So we've facilitated investments into 4 employee ownership funds here in the last couple of years, with Apis and Heritage and Obron, Groundwork, and then the Project Equity Fund, and there's a few others that are currently kind of under consideration.
Yeah, thank you. Yeah, and I feel like when we first met was probably right after that new era Windows. I remember those times. So it's really, as you say, really cool to see the evolution there in the field. So maybe, I feel like we've touched on some of it, but I'd be curious for your tight pitch on like why invest in employee ownership.
Yeah, to some extent, I think if we're interested in wealth inequality if we're interested in, racial equity, and social justice, I just don't see how we can not focus on employee ownership, right? I mean, I think it kind of gets at the heart of things, right? We've done some work over the years around sort of quality jobs, right? Ensuring that businesses are adhere to certain standards around kind of minimum quality job standards. That's important, and I think it gets to a level of sort of financial security, right? Addressing, getting low-income workers to a place where they hopefully can kind of take care of their basic needs, right? And that's no small feat in the U.S. These days. But it is not going to get at it's not going to move the needle in terms of wealth inequality, right? Because if you're gonna build wealth in any meaningful way, that has to be through some sort of form of asset ownership and sort of employee ownership as a key strategy there. So we really see it as core. It's also really appealing, just the notion that this is a strategy that applies to sort of the economy at large, right? So we're not looking at tackling a specific sector. It's not just about energy or food or education, right? There's an opportunity here to really touch any part of the economy, right? Whether it's auto shops like our friends at Common Trust invested in, or a landscaping business like our friends at Apis and Heritage invested in, or bakeries. We can really, it's not a vertical strategy, right? It's a horizontal kind of strategy that cuts across the economy at large, and that's really appealing. And then I would say too that it gets at the heart of this sort of fundamental question of sort of power, right, and rights, and the sort of relative distribution of returns, and the relative distribution of power and governance, right, and decision making. And so if we're really looking at questions like the primacy of capital, as Marjorie Kelly so eloquently writes about, this is the sort of the core of the system, right? This is the plumbing that we need to tinker with.
Yeah. Yeah, thank you. Oh, I love that. Such a cool, such I think, compelling recap of the different layers in which people come into this work, right? There's like the practical of just wealth and wealth inequality, and more broadly, like thinking about who gets to decide and who has power. So just to get into the kind of the more practical pieces, like what do you look at when you mentioned you're, still considering there's more and more funds to consider every day. What are the key elements that you evaluate when you're diligencing funds and looking at what's out there?
Yeah, well, I mentioned that kind of our evolution over the years from looking at just sort of pure co-op models to some of these newer, more diverse strategies. I think ultimately we're looking at how the ecosystem, how fund managers can simultaneously achieve three goals, which is a pretty tall order. One is to offer a compelling proposition to sellers, right? To the founders, the owners who are looking to sell their business, and being able to offer them a path that offers sort of a competitive return or valuation for them, as well as a path that is not sort of 10x more complicated than other ways you could sell your business, right? So that's sort of one piece of, or one leg of the stool, right? The second is being able to design a strategy that offers investors something that and this is, I'm sure we'll talk more about this, but something that resembles kind of risk-adjusted returns, right? I think there's definitely a kind of an asterisk there, what that means and what's the benchmark, et cetera. But ultimately, I think it is the case that for these funds to break the kind of glass ceiling of, say, that $50 million mark, you kind of need to expand beyond the deep kind of concessionary philanthropic capital, right? It's just the reality. And then, so that's the second leg of the stool, right? So offering investors sort of what they need. And then I would say the third leg of the stool is doing all of that while also really focusing on those core impact goals, right? So still, really being focused on workers from marginalized communities, low-income workers, workers of color, and designing conversion models that actually create real benefit and real power to those workers, right? So I think those are kind of the three vectors or verticals are that you're trying to kind of optimize around, and certainly not easy to hit all three. And there may be kind of different strategies that optimize more on some of the others. I will say, I mean, we have some latitude in that we work with investors, clients who have the appetite and the desire to really be innovative and be flexible in terms of their risk expectations or return expectations. That's great. So we're able to not just pick, hey, we need this kind of unicorn strategy that does everything and that achieves everything all at once. We don't, right? Which is why we have been very actively supporting new funds, knowing that we are in sort of an experimentation phase. But ultimately, I think there's kind of a path towards that is kind of what we're looking for.
Yeah, thanks. I feel like these, the returns and the impact, like in some ways we talked about and definitely want to circle back to, but maybe let's double click on the value prop to sellers, because I feel like that's one that we don't hear a lot about. And I think there's a lot of interesting potential strategy there in terms of, at what point in the life cycle do you target folks actually before they're even thinking about selling? Are you competing head to head with private equity? Or are you actually looking at segments of the market that are overlooked by private equity for, whatever reason? I'm curious if you could just say a little bit more maybe around that compelling value proposition to sellers and what might investors be asking, the questions they might be asking, or what are some things to look for?
Yeah, no, I think that's probably where some of the ESOP strategies are, there's just a bit more of an ecosystem, right? And an industry around those strategies, as well as obviously the well understood kind of tax benefits for sellers. And so you see ESOP funds, whether it's a Mosaic Capital Partners, whether it's a 8% Heritage, really competing kind of, I pretty much trying to compete head to head, right, with private equity firms and offer a competitive kind of like for like path to a seller, where the seller is not necessarily motivated to buy. So employee ownership doesn't need to be, or maybe there's a slight preference for employee ownership, from a legacy and kind of impact perspective, but ultimately they should be able to pick this strategy even if it is if it's kind of a blind test, if they don't know who the buyer is, right? And so that's one approach. Again, just really leaning on those tax benefits. At the same time, I think what we have seen is, there's many reasons why why ESOPs may not be the preferred path for a seller. I think you mentioned a couple of them. Whether it's the fact that ESOPs may not be sort of if you're looking for more of a perpetual solution, right? If you're looking to sell this to a long-term owner, that may not be the case for an ESOP. An ESOP, it can still be very much like an acquisition target by a P firm or a strategic, and may not last long term. So that might be an issue if you're for a seller, if they care about that. And there's also just challenges related to the kind of sustainability of ESOPs from a financial perspective in certain industries, knowing that you have to set aside cash to buy out your retiring workers. And so if you're in an industry where if you're a company with a rapidly increasing valuation and a lot of retiring workers, that might be kind of a treadmill that's very hard for you to keep up with. And then, a case like an organically grown company that we mentioned here earlier, if you care about multiple stakeholders and you don't necessarily want to optimize for just one stakeholder, the worker stakeholder, ESOPs, again, may not be the right solution for you. And so that's where I think we were part of what drove our interest in strategies like Common Trust and their Groundwork Fund and or Obron cooperative, really looking at other paths. Again, we don't believe in one solution for all sellers. I think it's important for all of these solutions to grow and be out there, right? So looking at Common Trust and Groundwork Fund obviously have really leaned into the EOT, the employee-owned trust model, as a more flexible solution, probably kind of cheaper to administer than an ESOP, less regulated. But they have they are, I would say, currently, because they don't have the same tax incentives or the tax benefits that an ESOP would have. They are primarily talking to sellers who are more motivated, right? Who are not comparing this path to selling to a private equity firm. They're not competing, I believe. They're not doing much. They don't tend to compete head to head with these other buyers. They're really talking to founders who are more motivated to go down this path. And then the Obron model, which I think folks have mentioned here in the chat as well, which was interesting in that it kind of decoupled the conversion process into two phases, right? The first phase is just an acquisition by Obron, which happens to be a holding company structured as a cooperative, but where the seller shouldn't really mind much, right? They should be getting a competitive valuation, and there's no immediate changes to the structure of the business, except now the business is now owned by a cooperative instead of being owned by their previous owner, right? And then post-acquisition, kind of phase two begins, which is really more of the kind of transformation of the business into what it means to be part of a cooperative and creating employee sort of benefits and participation. So basically all different ways to get around that challenge, which has been a huge challenge for the industry and for intermediaries over the years, which is actually closing transactions, right? Actually getting sellers to choose this path.
Yeah, thank you. Thanks for breaking down kind of those different pathways. And definitely there's like no one size, and there's so many different businesses, right, that folks are thinking about. Having a variety of funds in the market allows sellers to increase their awareness, and then for sellers to find the path that makes most sense for them, and hopefully that's an employee-owned one. Maybe let's go to questions, because I'm seeing a lot of things in the chat, and would love to hear kind of get folks' questions in. Kurt, do you want to tell us which question to start with?
Yeah, sure. Yeah, thanks all, and keep them coming. We're keeping track of them, and we'll try to answer as many as possible. So I have a question from Nikki Anderson early on that I thought was really is a good, and we get this question a lot. And it's, do you think there are more startups looking for employee ownership friendly investors, or more investors looking for employee ownership startups? And how can we help these groups find one another? So as usual, it's kind of, the answer is it's complicated, and it depends what segment of the economy and what models and what fund types you're looking at, because we actually hear both of those, like, oh, there's plenty of pipeline or there's not enough pipeline. It really depends on kind of where you sit. But to get a little bit more granular, in the US at least, and Nikki, I believe you're working in Europe mostly. Most of the startups are cooperatives for a variety of reasons. There's not a lot of ESOP or employee ownership trust startup companies. It's just kind of expensive. The economics work out easier if it's a slightly bigger and more mature company. So when looking at co-ops, there's actually a pretty robust ecosystem of financing for cooperative startups in the kind of traditional, or I should say typical kind of, like small, 5, 10, 15 employee co-ops. There's definitely a gap for startup co-ops when you look at, high growth oriented co-ops, those that need kind of that missing middle, like 250K to $1 million of investment capital. And a few different folks have worked on that. Zebras Unite had their P6 Capital Initiative. Start.coop has a great accelerator program. But I think that's one of the instances where you actually say there's actually not enough of this type of capital for that kind of business. And then when you look at a lot of the funds in the database that are doing more conversions work, again, it really depends on kind of like how narrow the focus of a fund is, right? Like if you add on all these impact angles and you have, size and sector considerations, you're kind of narrowing the funnel of potential businesses, which is great if you have a strong impact thesis behind doing that, but that will obviously shrink your pipeline. Generally, what we hear is that there are plenty of companies that are ready for employee ownership conversion, and a big issue is just awareness, educating business owners and investors that this is possible, and really kind of like just doing that connecting work. Like there should really be plenty of businesses for most of these funds that do kind of fall under their investment scope. I'm gonna also let folks, who are really doing this work, some of the fund managers, folks who, have invested in funds, if they want to share their experience with that question in the chat. I think it's a really juicy one. But I think we can also take another question. Julie.
Yeah, maybe Matthew, we had a couple questions from you. I don't know if you want to choose your most important one. There's a lot in there, but yeah, but go ahead.
Thank you so much for indulging me there. And yes, I would ask the first one. I think maybe a bit juicier. So about, I'm actually losing it in the chat, but basically I was asking about Marjorie Kelly making this comment on the Freakonomics episode about Pete Stavros and the ownership work / KKR model, and described it as a step up on a downward escalator, as kind of like it's slightly better, but thinking about the bigger picture. So I'm just curious, like how you see influencing the landscape of these like private equity employee ownership transactions to maybe more consciously and actively engage with that democratic governance piece.
And is this something you have a perspective on?
I mean, I think in general, we are interested in a range of strategies, right? Not necessarily, hey, this has gotta all be down in this kind of purist lane. At the same time, we are going to look at any strat. We haven't looked. I mean, KKR is not I mean, beyond the kind of public stuff or the Freakonomics episode earlier. I haven't looked at it in depth or kind of personally. But we are always going to apply, as I said. I mean, we're looking to, kind of hit those three questions, and that third question around impact is always front and center. So if you're doing this but really straying away from what this means for workers, then obviously we're less interested. Yeah, I mean, I think there is a question around whether this is a one-time kind of wealth creation event. There's an exit and workers participate. That is better than having them not participate, right? But is still working in that within the system of companies being kind of bought and sold every 4 years by a private equity fund, which is not ideal, right? And they may there's always this question, right? Does that get retained once the company switches ownership? And I know Pete is making the case that it should be sustained because it becomes part of the sort of secret sauce of the business. But I think that is a big question.
Yeah, I mean, it's such a, I feel like it's depends, I think, in people's overall theory of change. Like, is it good to have more awareness of employee ownership and therefore it kind of opens the aperture, or does this mean that folks are going to be like, great, I'm done, I did this one thing? When we know that in terms of, if our goal is wealth inequality and the private equity models, is still the investors kind of reaping the lion's share of the returns. So it's definitely raising the floor, but not necessarily reducing inequality in and of itself. So it's an interesting, I think, fine line. And I think that's what makes the space interesting too, is like, there's a lot of complexity to wrestle with here. I want to surface Rachel's question in the chat, just as Rachel says she has a lot of questions. I'm a future seller, will be scaling, adding team members over the next few years. I'm really interested in information about how to best build and exit an O company. I feel like there's probably 8 people on this call right now who can answer that question. So if you want to maybe ping Rachel with your contact information or just be in touch, I feel like, Rachel, there's definitely folks here who are in the business of supporting and helping business owners and supporting them. So, I see, I see a lot of folks here. So hopefully someone contacts you and you get kind of the support you need, because I'm very excited to hear that. Thanks, everyone. Thank you first and foremost, Anair, for joining and for sharing, your extensive experience and expertise. Thanks, everyone, for joining. I love in my breakout, we had, we ranged from, the ESOP world to political power building. So I think the range of this field is one that I find very exciting, though sometimes overwhelming. So excited to, very grateful to have you all. Thanks to Transform Finance team, thanks to Kurt, thanks to Sophie for helping to make this all happen. And more coming soon. We have our website, the Alternative Ownership Enterprise Learning Hub, where we keep posting more materials and information. So feel free to consult that. And thanks for putting the link there in the chat, Kurt. And thanks, everyone, for your time. And thanks, everyone, for your work. Always very, very inspiring to be in community with all of you all. So thank you. Have a great rest of your day.